As we come closer to the end of Unit 4 under Financial Management, we now turn our attention to something known as Capital Asset Pricing Model. That's what we're going to cover in this particular section, and that's an extension of what we have learned so far in terms of what risk premium is required and beta. This is a theory which basically outlines what return to expect from any security, from any security. That's the question we are trying to answer in this case, right? So we quickly revisit our discussion around beta. Now, first let's understand that risk premium. What do we mean by risk premium, right? Or market risk premium. Now, if you are investing in the risk-free asset, you will make a return RF, right? Which is by taking any risk. Now, the return expected by an investor over and above the risk-free rate, right? This is what is the excess return that you're expecting for taking higher volatility or higher risk. And why are you taking this higher risk is because you are investing in the market portfolio, right? So you're investing in this market portfolio, which is a secured set of securities in the equity market. And because you're investing in this, which is, let's say, something like the BSE 30, you would expect a slightly better return over and above the risk-free rate. Remember, risk-free rate has sigma close to 0, whereas we saw that for BSE 30, the annualized sigma was equal to about 17%. Now you're taking this risk, so obviously you would want to kind of get a slightly higher return. This is the excess return that you're expecting out of any out of investment in the market. Now recall also what we said about beta. Beta of the stock, any stock, gives the magnitude of movement, when the market moves, when you compare it with the market, right? So if you're looking to find the risk premium for a stock, how would you give that, right? Remember, stock moves beta times the market. That's what we had seen. So if your market is giving you this excess return, beta times that excess return is what you're going to get on the stock, right? That is the excess return that you expect on the stock. This principle is what is called as the capital asset pricing model. This is one of the basic tenets of finance. Remember, beta is assumed to be the risk, the market risk. It's assumed to be the market risk or undiversifiable risk that a stock adds to the portfolio, right? So it's a measure of risk that the stock adds to the portfolio. And so for investing in this particular stock, this is the risk premium demanded for investing in the stock, and this here is the risk premium demanded for investing in the market, right? Now obviously the risk premium demand for investing in the stock is going to be beta times what you're going to demand for investing in the market, and that is what capital asset pricing model will say, which means the expected return on the stock, I'll take RF on this side, becomes risk-free rate plus beta into RM minus RF, where RM is the market return. That's what our calculation is, and that is what CAPM tells us, right? Now let's assume that we are plotting a line, and we are plotting a line between what is the expected return on the stock And so far, remember, we were plotting a line on the x-axis, we were using sigma. Now let's say we put beta here, right? Now beta 0 is where you will have the risk-free asset, right? If you draw a line now as beta keeps increasing, on this side, beta increases on the right hand side, your return expected from the portfolio will increase linearly, right? That's what we said. Return on the portfolio or the stock is going to be equal to risk-free rate plus beta into RM minus RF. So it will increase linearly. Beta is X, return on the stock is Y, this RF is the intercept. So obviously the slope of this line is what is RM minus RF, or the equity risk premium or risk premium that you are expecting for investing in the market. That's the slope of this line, right? That's how the line would look like. So your expected return on the investment plotted against the beta. This line is known as the security market line or the SML. Note that the CML was return versus sigma. The SML is return versus beta, right? That's the key difference that we have seen so far. Now on this, the intercept, and you can write the equation again. R is equals to RF plus beta into RM minus RF, right? Beta is on the x-axis, so this is X. This is Y is equals to C plus MX, right? What is M? M is RM minus RF. So the slope of this line is RM minus RF. This is the return that you're looking at, right? Now note a few things here that we need to understand. The market portfolio is given by this point. That's the return on the market RM. This is the difference RM minus RF. And if you think about it, this is where beta has to be 1. Remember, market beta is going to be equal to 1 because the market will move 1 times itself, right? Treasury bills or risk-free securities will have a beta of 0 because they are kind of completely riskless, right? And you could have portfolios or securities where beta could be anywhere ranging between 0 to anything on the upside, right? There has to be a linear function, which is what we have derived as the line y is equals to mx plus c. That's the line available here. And you obviously have a certain set of securities that are available as per this model on this line or above or below this line. Now we are supposed to test whether portfolios can lie above or securities can lie above or below this line. For that testing, we'll have to introduce a few concepts. At this point, I should also tell you that if you want to look at the portfolio beta, right, that's a simple weighted beta of constituents, right? So if we have 50% in a stock with a beta of 1.2 and another 50% in a stock of beta 1.6, the portfolio beta will be 50% into 1.2 plus 50% into 1.6, and that's going to be 1.4. That's a simple weighted average that you're going to look at when you're looking at these constituents. Now let's question whether the securities can lie above or below the security market line. Let's take an example of two securities, one somewhere here and the other somewhere here. So let's say point A and point B. A security with a beta of A, 0.5, and a security B with a beta of 2. Can they exist here? Now note that if you're buying this security that adds a beta of 0.5, you can actually replicate the same beta. You can replicate the same beta by what? by investing 50% of your portfolio in the market and 50% in the risk-free rate. And that will be somewhere here, this point, right? And you know that the return on this point, which is R2, will be greater than the return on this point, which is R1. So why would anyone buy this security A? No one would buy this security A till the time the price of A falls. Price of A falls such that expected return goes up, and expected return goes up to R2, which means no one will buy the security A unless the security A is on the SML. It is on the SML. It can't be below the SML, right? If it is below the SML, you can create a portfolio of 50% market and 50% risk-free rate, and that will give you a better return profile, creating the same beta, right? Why? 50% into 1 and 50% into 0, correct? That's the first case. Let's take another one. Now let's assume we are talking about this security here, which is B. You can get a return R3 by investing in B, but if you want a beta of 2, you can borrow $100 at risk-free rate, and if you have 100 already, invest 100 plus 100 in market portfolio, and effectively you can borrow and create a portfolio which will lie somewhere here. And again you will find that R4 is greater than R3, so no one will buy this stock B till the time the price of B falls such that expected return on B goes up and goes up to the security market line, right? So for all practical purposes, unless A and B lie on the security market line, people will not buy these portfolios, we buy these stocks. Now, it should mean that securities cannot lie below the SML. Since on average, securities should lie on the securities market line, therefore no securities can lie above it as well, which means all stocks are on SML, right? The stocks will have to be on SML or the prices will move to kind of create stocks on the SML. That's what the theory says about capital asset pricing model. It's an important concept because whenever we are going to use a discount rate, recall our discussion on NPV, right? To find NPV, we need a discount rate, which is nothing but the cost of capital, right? Cost of capital is the expected return that you would want on a project, right? If you give me money for a project, what is my cost of capital is the amount that I have to pay you, and that is going to be your expected return. And this expected return, if you're investing in this project as an equity holder, is going to get defined by the risk entailed in this project, which is given by the capital asset pricing model, right? So this all ties into the first discussion that we had around NPV and the discount rate, and this discount rate is being calculated by the capital asset pricing model, and that's where the importance of finding this discount rate comes in. This is obviously a linear function of beta. Higher the beta, higher the expected return from that particular security. Lower the beta, lower the expected return from that particular security, right? That's what capital asset pricing model says. Let's review it. So there are some basic tenets that are there, which is all investors want higher returns and lower risk. They seek efficient portfolios that return higher amounts at lower risk levels, right? That's a basic expectation everyone has. An investor will borrow and lend in risk-free rate if he is allowed to do so, he or her is allowed to do so, and create combinations of the risk-free asset and the optimal portfolio in order to match her risk reward requirements. This is what the capital market line told us, right? Now, assuming, so ideally, what is the optimal portfolio? I would want to buy securities which are, so in this, I would want to buy undervalued securities where I have information that these companies will do well. But if no one possessed superior information, which is the fact that everyone has the same information about a set of stocks, then everyone will tend to go and buy the entire market portfolio. The efficient and optimal portfolio for everyone would be the market portfolio, right? So we reach a claim where everyone is holding a market portfolio as a diversified investor. Now, beta measures the risk contributed by a stock when added to the market portfolio. So what does this boil down to? If everyone holds the market portfolio and if beta measures the risk contributed to the portfolio by each security, right, then the risk premium, which is the return demanded, is going to be a linear function or proportional to the beta. So essentially we have which is what basically CAPM says. So that's a summary or review of the CAPM, which means that everyone, that's an assumption in CAPM that everyone will hold the market portfolio, and because everyone expects a certain risk profile and there's no additional information available with people, and because there is no additional information available, everyone holds the market portfolio, they will perceive the risk of a stock exactly proportional to its beta, right? And the risk premium that you demand for that stock is going to be directly proportional to its beta, or the systematic risk it adds to the market portfolio. That is what CAPM says. The more important concept for us is that expected return for an equity holder in any security is derived from the CAPM formula. This is one of the most common theories that is used. While it is a simple theory, it's conceptually the best available framework that is used at this point of time in the markets. There are some other theories as well to arrive at the expected rate, but either they are too time consuming or they require a lot of sophisticated methods to arrive at the discount rate calculations. CAPM, by contrast, is a fairly simple to comprehend model. It's a direct linear understanding on, practically speaking, this is the risk you take for investing in the risk-free asset. This is the premium you demand for investing in the stock market. And this is the additional scaling factor, beta, which you would expect when you're investing in a particular stock, right? That's what CAPM says. That's broadly the outline of CAPM. And this is going to form the crux of valuation exercises in modern day finance from here on, right? The entire tenet of NPV and discounted cash flow valuations follows CAPM. Quickly, the discussion between security market line and capital market line, commonly confused concepts. The first one compares return with beta, which is only the systematic risk. Capital market line compares return with risk. So here you have return versus sigma. Here you have return versus beta, right? This is for a stock, while capital market line is for the entire portfolio. Market portfolio is when beta is 1. Here market portfolio, it's the tangency portfolio. Remember, this was, if you were drawing a tangency portfolio, this is the market portfolio, whereas in this case, wherever you have beta equal to 1, that's your market portfolio. That's the broad difference between SML and CML. For our understanding at this point, this much is enough. Just remember the crux that the SML is the relationship between the returns expected on a stock and its beta, and that's a linear relationship. Higher the beta, higher the expected return of the stock, higher the discount rate that you find on the project, right? Quick question as we end this particular section. Explain briefly about the securities market line.